When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Hogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Hogan. And now here's Jeff Hogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Hogan, the radio show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events. We'll also answer some listener questions. And finally, why AI alone doesn't cut it for financial planning. My name's Jeff Shade, and as always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from Jeff Hogan of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing today?
I'm doing great. How are you doing?
I'm doing fantastic. Thank you. Glad to be with you, and certainly glad to be with all the people here of the greater Tucson area and our listeners here on 790 KNST. Jeff, let's talk about economic news. I understand that Elon Musk is now railing against Trump's tax bill. He calls it a disgusting abomination. I don't know. It doesn't seem like they're getting along too well these days. What do you make of that?
Well, Elon Musk has a business that relies in a large part on imports and tariffs and things like that. The tariffs on other countries are going to be higher for the goods that he tries to export and sell in those countries, and they're going to be higher for the parts that he has to import. It's basically an incentive for him to start building more, although he does quite a bit of his production here. I think also he's more involved in the actual world trade situation where Trump is a businessman, and he's got businesses that, do a lot of importing, and got a clothing line and different things that I'm sure the tariffs are going to affect him as well. But I think Elon Musk is a little bit more exposed to that, and it bothers him a little bit. There's a lot of people that don't agree with Trump. There's also a lot of people that trust him because the economy was better when he was in office the first 4 years until COVID took us down. And that was kind of a manipulated situation by, I think, some people who had a very dark agenda and created a situation that tried to blow his presidency up. And it actually worked after manipulating another election right after that. But anyway, I think people do remember that things were better before that while he was in power, making the economy better and trying to make America great again. He's doing the same thing. So I think there's a lot of confidence in the average consumer, but there are businessmen that I think are not very happy with it. I don't think Elon Musk's leaving the White House and the Doge, oversight had anything to do with the big, beautiful bill. The other thing is the big, beautiful bill isn't as big and beautiful as Trump wanted it. I mean, there's some tax cuts that were promised that aren't quite as good as they were promised. The tax cut on Social Security isn't free Social Security for everybody. It's just a different level of tax relief. There's the tax on tips still might be subject to payroll taxes, I understand it, and things like that. There's some issues that didn't happen. And I don't know how much of what didn't happen in that bill is what Elon Musk is saying is an abomination. But of course, anything that isn't the big, beautiful part of it is going to be taken out on Trump, even though those bills have to pass through Congress. They cut them up, chop them up, rewrite them, and then they vote on them. And then they send it to the Senate and they chop them up, cut them up, and rewrite them, throw in all their pork and the other crap. And there is probably a ton of abomination in that bill, and probably tons more deficit spending that's expected now that it's been that all those congressmen that owe people favors have put a bunch of pork and this other garbage that always gets stuck in even big, beautiful bills. I think the gist of it is Trump wants taxes to be lower so that the businesses and the consumer can spend more. Generally speaking, that does tend to create a little bit more of a slanted benefit to the more wealthy in some cases. But I don't see how, when they're complaining that everything is basically focused on billionaires and people that are mostly cronies of Trump, when no tax on tips and no tax on Social Security, that doesn't affect or change the life of any billionaire I know. So there's a lot of things in there that I think are beneficial to Americans in general. We did see GDP go up. We saw job openings go up this past week. The numbers were incredibly optimistic. I was surprised by them. In fact, very encouraged by them. Some people say, we averted a recession because look, our GDP didn't go down again. So it's on the way back up, which usually you have GDP falling in 2 consecutive quarters means a recession. Of course, when that happened during Biden's watch a few times, they just said, that doesn't count now. We have a different idea of recession. And it's only when the market crashes, and we'll keep the market from crashing by manipulating it. So they can keep us from thinking there's a recession. But the fact is, if we go back to GDP and how much we're producing, how much job creation we're getting, how much new jobs, how much wages are increasing. But more than wages increasing, wages can increase, but if taxes increase too, that doesn't help us. If inflation takes away those wages, it doesn't help us. So inflation has to go down, which it does seem to be staying pretty cool. The interest rates are high enough to where I think it's keeping it at bay. If they lower interest rates, I think we might see some inflationary pressures again, and that would cut into some of this GDP growth or some of this ability to spend. And back to my original point I was trying to make a second ago, but is what's really more important is how much does a consumer actually have to spend and feel comfortable spending, the discretionary spending, the things that they get to choose to spend on. I mean, nobody gets to really choose to buy food or medical care or gas to get to work and just the basic necessities. But what really makes the world tick and what makes the world go round and what makes the economy grow is those discretionary expenditures. And so if consumers end up keeping more in their wallets and businesses end up keeping more in their companies so they can hire more people, they can spend more on maybe their own infrastructure growth and their own expansion, instead of just having executives take bigger and bigger bonuses and fat cats get fatter. If it does trickle down, which it should, but doesn't always, then the world's going to be a better place and America's going to be stronger. And I don't think that big, beautiful bill and the abominations that Elon Musk are talking about and others are talking about are going to be as abominable as maybe seen if you just do simple math. Elon Musk is not only a brilliant engineer, I think he's a pretty good economist, but I think Trump trumps him, no pun intended, actually pun intended, on economics, I think, just because of his sheer experience and years in the American business world and looking at how taxes affect him on a day-to-day basis, what he would do in business. I think he says, well, this situation would help me. Why doesn't it help all the businesses? I think some businesses are built on slightly different models and, may take exception to this big abominable bill, but I would love to give it a chance. I think the things that have been happening at least the last 4 years and during other administrations where we're just printing money and making the economy look good by faking it out and just throwing money at it, those days are numbered. You can't do that forever. And so we have to get actual economic growth through other means. And I think Trump, I'm certainly willing to give his theories a try. I'm not as smart as him in running billion-dollar businesses. I would love to say this business is worth billions, but we're just a small boutique shop that helps the people that we help. And I understand taxes from the standpoint of my world, but on a macroeconomic level that he's more familiar with, I've just got to defer to him and his expertise. We hired him. We voted for him. We put him in office to do a job. I'd like to see him do it as best as he can. And if it doesn't work in the next 4 years, we have another election, right? We'll vote somebody in that has a better idea. I lean toward what most Americans lean toward. And I think the polls came out 53% are in favor of what Trump's doing. I mean, that's a pretty darn good satisfaction number for poll numbers this early on in a presidency. And I think the optimism and the outlook that the economy is better and getting better is also, those numbers are huge. So I'm with the general public that I think things will get better. I also think that although I don't think we necessarily averted or have totally avoided any thought of recession, because what little incremental increases we're having hasn't fixed the bigger problems that we've had that have been accumulating over the last several years. So I still think there's room for caution. I think there's room for a little bit of reserved jubilation here, and not to be overly excited or let's say irrationally exuberant about the idea that GDP is up and the market's heading back towards its all-time high. Although it's not there, it's really having a hard time cracking the 6,000 mark on the S&P, right? The SPY, if you look at that index, it just keeps on trying to butt its head up against the 6,000 number and just hasn't seemed to cross over that. So let's see what happens. I think if we can keep Trump's philosophies in play and let him do his work, I believe that earnings will eventually catch up to the overpriced valuation of the market, which means either the market's going to be flat, or if they want to meet in the middle, the market will probably correct downward a ways until the fundamentals start catching up to the valuation of the stock market, and we'll be on better ground moving forward. So either we kind of get in a choppy market while Trump's philosophies and theories and the abominable big bill, as Elon Musk call it, but the big beautiful bill takes shape. I think over the next few years, we're going to see things settle in, and I think the fundamentals will look a lot better. I think looking back, we'll think that it's not as abominable as Elon Musk thinks, and I think looking back, we might not think it's quite as big and beautiful as Trump thinks. It'll probably be somewhere in the middle.
Talking with Jeff Ogan of Premier Retirement Planning and Wealth Management, we're talking about Trump's big, beautiful bill, Elon Musk's pushback on that. Something I do want to reiterate that you said, Jeff, is that this bill is not finalized, of course, has to be voted on again, and it is subject to a lot of change. There was something in there about eliminating Social Security taxes, and of course, that was taken out of there too. So this is still a work in progress. Let's continue to talk about current events here, Jeff, and talk about what's happening with inflation and with interest rates. I understand that the Fed Governor Christopher Waller says we're just about ready to lower these interest rates. Fed Chair Powell has a say in this too. What do you think? Inflation 2.1%. Do you think we'll see these rate cuts sooner than later?
I think we'll see some this year. I think it's going to be more on the back of more recessionary pressures. I think Trump wants in the worst way to have the market go up. I think there's a lot of pressure for him. And as long as he gives pressure to the Fed Chairman Powell, I think Powell's going to probably resist. If he sits back and quit saying stuff, maybe Powell will do it. Now, keep in mind that typically what starts or happens before the actual recession and market sell-off is usually there's a rate cut or two that signal. Actually, what it does is signals to smart money in the economy, big economists and even market makers, the big banks and brokerage firms, that, okay, if they have to lower interest rates and the economy isn't as strong as maybe we're thinking it is or people are believing it is, and so maybe it's time to sell into this situation. But the street investor, the household investor, typically the non-smart money, the non-Wall Street money, typically says, oh, lowered interest rates, that's going to make companies be able to borrow cheaper and it's going to make better economic numbers. More people can buy houses, blah, blah, blah. And this just looks great. And so they'll throw their money at the market. But smart money, typically, like we know Buffett is about a third in cash. We know that the market makers have reduced their holdings in a big way. The market makers, they're the inventory holders. They're the JP Morgans, the Goldman Sachs, the Bank of Americas and Merrill Lynch, Wells Fargo. All those guys have been selling into this 2-year market rally. They're happy to sell you overpriced stocks at overpriced valuations because you're over exuberant about the market. So they'd be happy to let these Fed rate cuts inspire you to buy more because they'll probably sell more. And pretty soon when they realize that the recessionary pressures are finally culminating and the multi-bubble is about to pop, and it might pop slow, maybe there's just a leak and it'll go down, but there will likely become some sort of a sell-off, I believe, just because history repeats and we're still in a mess. The good news is Trump's making some positive changes. The other good news is most of the people are believing in it. And so there's a certain sense of calm about the market, but sometimes the calm is the calm before the storm. And it's not necessarily healthy. So if we see interest rates drop, it may look good and it may make Trump happy, but it may also signal the start of the cycle that typically ends after 1 or 2 rate cuts where there's a recession. And then there has to be more rate cuts in order to get things to pump the market back up again. And at that point, if there is a sell-off, we'll see institutions, pension plans, and all the big money, all the smart money, the Ray Dalios and the Warren Buffetts and the people that we've spoken about before, the Druckenmillers and even Soros, I'd hate to mention his name, but these guys that are typically waiting and maybe even ready to create a crash when the time is right so that they can buy cheaper. And I think the banks and the brokerage firms are certainly ready to do that at any given moment. They're just sitting back waiting to redeploy their cash. And I think it's probably smart that we follow the same ideas, at least to a certain degree, as smart money. And that's why we've been largely in cash over the last couple of years, even though the market's gone up. It's very overvalued. And I think there's still going to be better days ahead where the fundamentals make more sense to get more heavily involved in the market. Now, having said that, we manage money here and our growth portfolio did really well last year, beat the market, beat most of the other hedge fund managers that we used to use and partner with. This year, we've had a pretty rocky road, just like the market, but over the last month, we're still ahead of the markets. But I still want to underscore the idea that the market's very risky. It's a place where the faint of heart shouldn't be playing. If you're retired and faint of heart with big market losses, then it's probably still not a good time to go in. If, however, you have a chunk of money that you believe in and we can still start reinvesting in the properly priced stocks and wait for things to settle out, there may be some opportunities presently. But I think the big opportunities to say, okay, I can believe in the market again are still ahead of us. Not quite there yet. Again, if you have a long-term time horizon, I don't think the market's as scary a place to play now as it was a few months ago while we were still trying to wait and feel out what the tariffs were going to do to the market, what the Fed would do to interest rates, if inflation was really going to settle down, if GDP would start increasing again. And all those things have turned a positive corner, in my opinion. So, we're looking at a place where I'm certainly a little bit more optimistic, notwithstanding it still would be silly to throw caution aside. But to move forward responsibly and just looking at what's out there. But again, I think the headwinds are now becoming maybe crosswinds or maybe even tailwinds to some degree. Looking forward to seeing how this all plays out.
520-780-9059 is our telephone number. If you'd like to get in and sit down and talk with Jeff, you've been listening to him just for the past few minutes, and it's quite obvious that Jeff does have his finger on the pulse of what's happening in the market and the economy. If you'd like to put that sort of knowledge and power to work for you with your financial portfolio, we are offering this Premier Retirement Roadmap with Jeff. Absolutely no cost, no obligation. It's just a casual conversation between you and Jeff to take a look at your portfolio, poke holes in the weak spots, and really put you on a path towards a more confident retirement. 520-780-9059. Make that call today. You'll leave your name, telephone number, and Shelley will call you back during the week to set up that appointment for you. Again, no cost, no obligation. 520-780-9059. You can also find out more about us online at premret.com. Jeff, let's continue our conversation here about current events. There was a lot of talk about the 2017 Trump Tax Cuts and Jobs Act a few months ago. We've gone a little while without hearing about that, and in another month or so, it's going to be halfway through the year. What do we know about that? Do you think that that is definitely going to be extended? I mean, it affects about 62%, if not more, of most tax filers.
I hope it's extended. I am expecting it to be extended. I can't imagine why it would not be extended, other than maybe as a compensation or some sort of a quid pro quo. Certain people will vote for the big, beautiful bill as long as he doesn't keep those tax cuts in, because they see it as a place to raise a little bit extra revenue to offset some of the tax cuts that are being implemented on the new tax bill. So, yeah, I don't know. I would expect them to. I'm making plans as if they're still going to stay in place, because I really am leaning towards that. We have to look at the idea that if they're not in place, what does tax planning look like next year? But it remains to be seen. I'm optimistic that it will. I can't imagine, with the focus and the fact that that was kind of Donald Trump's baby before, I don't know why he would abandon it now. So I'm optimistic that'll stay in place. And if it doesn't, it goes back to a little higher taxes, but we still need to make plans to reduce those, whether they, there's still tax planning opportunities with Trump's tax cuts, as well as whether it goes back to the old rule or stays the same. Nobody likes to pay more taxes than they have to pay. So tax planning is still a big part of what we do and what you should do. Every dollar you keep in your own pocket with your own family and your own portfolio is a dollar you can spend, and a dollar that the IRS doesn't just go and waste. My thinking is reduce taxes regardless. And if you've already gotten down to a close to zero tax bracket, or if you've done some tax planning in the past 4 or 5 years, we probably got you out of all those tax problems that would have otherwise crept back into your life if the Trump tax cuts go away. If you haven't made those tax plans, then it's probably a good time to get started, while there might still be at least this 1 year left to do some massive tax maneuvers and get ahead of it, just in case they don't reduce or they don't extend those tax cuts.
Well, I think there's a very reasonable chance that that's going to be extended. After all, I don't think Trump is going to strike down something that he originally did in his last administration. And as I said, it affects more than 62% of tax filers. Personally, I have benefited greatly from that. So I think we can pretty much count on the 2017 Tax Cuts and Jobs Act being extended. Let's talk a little bit about gold. I understand that the futures have opened around $3,300 an ounce. What causes gold to have such a spike like this? And I heard a commercial the other day that says, put gold in your IRA. What do you think about that?
I don't like gold in your IRA unless you're buying an ETF that tracks gold. I mean, if you're going to own gold and put it in your safe, it's stuff you're going to hold forever. It's not an investment that you want to sell, not an investment that you want to have to be forced to liquidate when required minimum distribution time comes, all that kind of thing. I think those gold peddlers are, I don't know, they've had serious conflicts of interest. If gold was so good, why are they just keeping it all? And it is good, actually. I think when we're seeing central banks all over the world buying gold and hoarding gold, China, a big buyer of gold, and other countries, our own included, is buying stores of gold. That gives me two thoughts. One is gold's going to go up just because people like it, but why do they like it? Gold is typically a hedge or a safe haven for people that think that there's troubled times ahead. And if safe money and big money and central banks are buying it, that concerns me and makes me think a little bit less about my level of confidence in the stock market making new highs and going to the moon. I think it's going to flirt around with the new highs. It might even break the new high and bring a lot of people that extra irrational exuberance. But those people that have hoarded gold are probably just going to continue to make money. We've got a big position in gold in most of our portfolios. Some people like it, some people don't. But I like a position in gold and silver and those precious metals, especially gold right now. And I think it looks stronger and stronger. The mining companies that support the gold business are also doing very well right now, and have been one of the best investments even through these choppy market times in the last year or so. So I think gold still has upside. Remember that this show we're not making any recommendations. We're not telling you to buy gold, but
right.
In our portfolios, we don't own gold bullion. You're paying about a 10% commission getting gold. You're paying a 10% commission getting out. You have to pay trust fees if you want to own it in a IRA. I mean, you've got to make 25 or 30% before you're ever going to make a dime on gold. I mean, 30% from a $3,000, $3,300 stock price, I think is over $330 when I looked at the futures this morning. We're looking at 30%. It's got to go to $4,300 before you even make money. I'd rather buy the ETF, the exchange traded fund that has almost zero fees If the market goes up 10%, you make 10% because the fees are almost negligible. So I think owning gold in an IRA is fine. Just don't do it the way these gold peddlers are doing it. There's huge commissions. They are making so much money right now, just basically on the spread. I don't know anything that has a 10% commission going in and out. I mean, that's 20% on a full turn. I mean, that's crazy.
Yeah.
And I don't know where you can get commissions much lower than that anywhere. And if you do, they're probably changing the spot price on you. So I'm not a fan of buying the outright gold unless you just want to keep 20 or 30,000 bucks or 100 grand or whatever it is. They just want to have in the safe just in case the world melts down and somehow the only thing your neighbors will take to trade you for a loaf of bread is gold or something like that. I mean, if war goes to hell in a handbasket and we're in dire straits and you think gold is going to be that thing that saves us from that rainy day, then have some. But if you're looking at it as far as an investment, do something that you can get in and out of that tracks gold, but doesn't tie you into this huge loss every time you buy and sell.
Before we get out of here for this segment, mortgage rates have declined. They go up, they go down. Why do mortgage rates fluctuate so much? What is this based on?
Based on bonds, bonds have been falling. And if the banks could put their own money in a bond at 5.5% or 6%, why would they give you a mortgage for 4%? They've not only got to buy their opportunity cost is really what they're betting against. And so it really has to do with the bond prices. And we've seen, especially the 20-year bond, that it tracks under TLT as the ETF that has the 20-year bond. And if you want to watch it, and it seems like that's really the number that you have to watch. If the bond price is falling, interest rates are going up, and typically the mortgage interest is going up. Sometimes there's a little bit of a tweak depending on maybe a bank wants to be competitive or something. Generally speaking, if bonds are falling in price and they've fallen about 25 or 30% since their high a couple of years ago, that's a pretty significant problem when you look at mortgages, which used to be 2 or 3%, which are now 7 or better. So until the interest rates fall and the interest rates fall in the bond market, and by the way, the Fed can lower interest rates, and they've done it a few times. And when they lowered interest rates, bonds fell as well. And at the actual interest rate, actual mortgage interest rates went up. So there is a disconnect between what you hear the Fed say and what actually happens in the real world. It's all attributed to what the price of bonds are and what the interest rates on that bond market is. So it kind of remains to be seen whether any rate cuts are going to help the mortgage market. We have seen a surge in house buying, I think, just in the last couple of months, it looks like. Housing market supposedly is getting stronger, but it always does around summertime when school gets out. People who have to move or want to move closer to their private school or out of a district that they hate because the schools suck there, they're going to be looking to move during the summertime. So that's typically a time when demand goes up anyway. So I don't think we're seeing anything unusual based on, oh my gosh, the economy's better and interest rates are going to go down, so we might as well lock in a mortgage now at 7.5%. Well, I mean, I don't think that's really the discussion here. It's really like, can I afford to live where I want to afford? And it really stinks that the interest rates are high, and I hope they go down so I can refinance in a few years. That's kind of how people are having to do this right now.
Jeff, before we continue, I want to remind our listeners, 520-780-9059 is our telephone number. If you've heard anything that piques your interest today, you'd like to talk with Jeff, get in there for your no-cost, no-obligation Premier Retirement Roadmap. Not going to cost you a dime. Call 520-780-9059. Leave your name, telephone number today. Shelley will call you back during the week and set up that appointment. Again, 520-780-9059. You can also check us out on the web at premret.com. Jeff, we're going to take a break. When we come back here on Premier Retirement, we're going to answer listener questions. And then later on, we'll talk about AI and how it may not be the thing for you for retirement planning. When our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
We appreciate you joining us each and every weekend for Premier Retirement here on 790 KNST, Tucson's most stimulating talk. My name's Jeff Shea, joined by Jeff Hogan, founder and president of Premier Retirement Planning and Wealth Management. We've had a wonderful show today. Remember, we're on the air for you every Saturday, 7 a.m., 9 a.m., and 1 p.m. Also Sundays at 11 a.m. If you've missed any part of our program today, you'd like to hear it all over again, you can do that by going to wherever you get great podcasts. Search for Premier Retirement with Jeff Hogan. You will find this show and all of our past shows so you can stay on top of your journey towards a confident retirement. You can also Google that, Premier Retirement with Jeff Hogan. That's going to point you to any number of different platforms and places where you can hear the podcast. Okay, Jeff, let's answer some listener questions. We picked out 3 of them this week. First one's Terry listening to us in Tucson. And Terry says, I've often heard that $1 million in retirement savings will be enough. Is that outdated today? I'm 62 and have about $800,000 in various investments. How can you help me know what the right number for me is?
Well, everybody's got a different number. I mean, there's certain people that are used to living on $150,000 or $200,000 a year, and if they've only got $30,000 in Social Security coming in, they might have a shortfall if they think they're going to keep the same lifestyle. Other people maybe have been earning $200,000 or $300,000 a year, and the reason they have $1 million in savings because they've been living on 60, and that's not going to be a problem for them. You know, there is a certain rule of thumb that I really hate because rules of thumb are typically always find a time to be broken. But if you took out 4% and you had all your money in the stock market and the market did what it did in 2000 to 2005, you'd end up running out of money in 25 or 30 years or even less, probably half that time. But, you know, when we do retirement planning, we try to figure out income and guaranteed income. We can figure out that there could be about a 6 or 7% withdrawal rate if you use guaranteed products, things that are insured, things that are like personal pensions, things that don't go down when the market goes down, and a guaranteed rate of return that's reasonable. And when there's no losses, you can take out a lot more money out of an account that doesn't lose, even if it doesn't average 10% like the stock market does, even if it doesn't average 4 or 5% like the bond market does. And if you look at the long-term history, bonds have averaged somewhere in the 5 range and the stock market's averaged over 10. You know, why is it that the rule of thumb, and you could even chat GPT or Google this and they'll say, what's the safe rate of return or a safe rate of income out of $1 million portfolio? And they'll say, well, 4%, but it's been revised as to, well, 4%, but of whatever the balance is. Well, if the balance goes down 50% because of a market crash and you had $1 million, well, now 4% is only $20,000 and you have a better chance of not running out of money. Well, that's weird. If the stock market averages 10 and the bond market averages 5, that you can only take 4 and you still might run out of money and you have to adjust downwards. The world of annuities and personal pension is what helps people live on 6 or 7% withdrawals guaranteed. I mean, we give people guaranteed income of $50,000 to $70,000 a year throughout retirement on $1 million plus liquidity that they can get out if they need it for other things. So you don't have to be saddled by the rules of thumb that Wall Street, who basically thinks they own the financial planning world, they're horrible at generating income strategies and income streams because everything that they offer is a stock or bond or cash, which doesn't pay anything, and a stock or bond, which all has risk. We've seen bonds go down 20 or 30% in the last couple of years. We've seen stocks go down 20 or 30% at a time. We saw it go down 50% 2 different times. And so there's all kinds of things that we have to keep in mind when you're taking income that you don't have to keep in mind when you're putting money away. So again, when you're putting money away, fluctuations in the market, volatility doesn't matter, but when you're taking income out, it definitely does. So is $1 million enough to retire? Well, it depends on how much you need to live on and how much you want to live on. I would say with $1 million, you know, if $60,000 or $70,000 in income for 25 or 30 years is acceptable to you, then $1 million is okay. If you need 100, then you need to have more. If you think you're going to do it with your stock and bond portfolio and mutual funds that you've got to retirement with, you better dial that back to 30 or 40,000. So again, if you need 60 or 70, you better have closer to $2 million in that stock and bond portfolio if you think you're going to make the retirement work. So our forte and just our focus is making the best out of what you have, no matter what you have. If you have less than the average retiree, we still want to have you get more income than the average retiree, because the average retiree stays with their broker that got them there and thinks the same results are going to get them through retirement. And then through the next market correction or so, they get a few gut aches and realize that they weren't on the right road. And then that's usually when they come see us. But if you're listening, maybe you'll come see us earlier before that happens, and you'll be on better footing before you have those wild stomach roller coaster rides with the market when it goes up and down.
Yeah, that's great advice, Jeff. Come see us before so we can possibly prevent the problem. But I think this is one of those big it depends questions. And it depends upon how long Terry's going to live. He's 62. If he lives to 82, that's 20 years. He didn't make anything on his money. It's $50,000 a year. It depends upon what your lifestyle is, your rate of return, all those sort of things. But Terry, we would love to sit down and talk to you, and I know that Jeff would entertain that conversation. 520-780-9059. Terry, if you want to come in and sit down and talk with Jeff individually about your situation, we thank you for listening to us, and we'll send you out Jeff's book, Retirement: The Road Ahead. Our next question comes from Ronald in Casa Grande, one of my favorite places, home of Desert Valley Auto Parts. Always love looking through the junkyard there. Ronald writes, what's the smartest way to draw down your accounts? Which tax buckets should I draw down from first?
Well, it depends. I like to do it based on taxes. Typically, we do the ones that are most tax unfriendly first so we get out of the tax bite, as long as we don't put you in a higher tax bracket in the meantime. That allows you to maybe move some of that money that's taxable. I'd rather you pay less taxes now on less money than more taxes later on more money over the rest of your life. I don't think taxes are going to stay as low as they are forever. I think Trump may extend the tax cuts, but I just think based on what I've seen in the last 60 plus years of my life, that the government doesn't do math the way an economist does. Trump's an economist, so he does it that way. But they're just going to say, oh, there's a shortfall. We need to raise taxes. So I think tax rates are probably going to go up as we get into a retirement. Just as you move forward through life and as your retirement progresses, you'll probably be in a higher tax bracket. And as you get to those ages where you have the required minimum distributions coming out, then you're going to be forced to take money out maybe that you don't need. So I would say pay taxes now while you're using it on as much as you can with whatever you can move to Roth IRAs or LERPs or some sort of a tax-free bucket. Pay taxes now as long as you stay in the same tax bracket you're at based on your income needs for living expenses, et cetera. Fill up that tax bracket so that you don't go into a higher one later. I like to minimize your tax brackets over the course of your life. And that's why we use basically a 30-year spreadsheet plan that shows where we're at, how much we should take out now as opposed to how much we should take out later. And we can see how we use different columns or different buckets of money is going to affect our long-term tax outflow or basically our tax bill. Most of our clients who come here, their biggest expense in retirement is definitely going to be taxes. Some are in the millions and millions, some are in the hundreds of thousands, typically more than what some people will pay on healthcare, which is deemed for most people the biggest expense in retirement. Well, if you're a person of means and you've saved a little bit and you want to live a reasonable, comfortable lifestyle, you probably have enough money to be in a high tax bracket. And if you aren't now, you will be when it comes time to start pulling those dollars out of your 401ks and IRAs that you've deferred forever. So again, kind of depends on your tax situation, how much money you have saved and what kind of techniques we can do. Now, if you're in such a high tax bracket that we can't actually get you to a lower tax bracket, it may be smart to incorporate some charitable gifting plans or some trust, some gifting and things like that, where you can get rid of some of your assets at the current tax bracket, maybe even use up what we call unified credits, which might get you out of estate taxes in the future in order to, again, pay taxes now on less money, even if it is the same rate as it will be in the future. I'd rather you pay taxes on less money than pay taxes on more money later. And I think the bias is really going to be higher tax brackets, no matter where you're at. So I don't have a problem with maybe getting kicked in the gut or punched in the face a couple of years with a tax bite rather than knocked in the gut for the rest of your life with a tax bite you hate. So sometimes it's okay to just feel the pain once or twice or feel the pain for a few years to not have to feel the pain forever. But you have to be willing to take a little pain. Sometimes people want to kick that can down the road so far, then all of a sudden they're in a place where they can never get out of it. And the rest of their life is a big tax gut ache. So keep that in mind. And again, until we put it on a spreadsheet, I can't really tell you an exact answer, but for everybody, it's a little different. I typically like to spend those tax unfriendly assets first and put them in tax friendly assets so that going forward, you know what your future is going to be. And also that you've got a situation where that if they change the tax situation, it's not going to change your life.
And again, Ronald, this is one of those it depends answers. So I would invite you to give us a call here at Premier Retirement. Sit down with Jeff and let him go ahead and take a look at what you've got and design that plan and get out the spreadsheet. 520-780-9059 is the telephone number. We appreciate you listening to us in Casa Grande, and all the best to you there. We'll send you out Jeff's book, Retirement, The Road Ahead. Next question, Jeff, is Steve listening to us in Suarita. Steve says, I'm 63 and plan to retire in 4 years. How can I make my portfolio more income-focused as I get closer to retirement?
Well, there's a lot of ways to create income. Some of the traditional ways have been, let's just put them all in income-producing stocks, or let's just go with bonds because that's supposedly fixed income securities. But we know if you've got, a chunk of money in the bond market and you need to take more than just the interest, you're going to come into a place where you could lose 20% and all of a sudden you're locking in losses again. So we've learned just the last couple of years that bonds can also go down. So I don't think bonds are necessarily a great option. I love the options that insurance companies have provided for us. Insurance companies manage more pensions than anybody, to my understanding. And you get all these big companies you've heard of, like some of the first responder companies in town, and they use Nationwide. They're an insurance company too. They do investments, but they also create pensions for first responders in the Tucson area. We see a lot of that money. Well, you know what? That same company has private investments you can do. I'm not touting companies. I'm just saying some of the names that you hear about just in regular life, these are the same companies that provide an individual pension that you can count on that will guarantee income much higher than what the stock market or the bond market can provide, and much higher than dividend stocks can provide. A good dividend stock might be 7 or 8%, but it reminds me of 5 or 6 years ago. I remember that AT&T, I'm just showing this out there, AT&T was a great dividend stock, paid like 7% dividends. But the stock went down about 7% per year. So you really never made any money. You have to really focus on, is the stock holding its value, or is it actually growing and I get dividends, or is it just paying me dividends and I'm just using up my profits only so I can sell out with a net loss or a net break even when the time comes. So keep in mind that dividend stocks aren't always just cracked up what they be, and the dividend yield is not what necessarily you'll make with the stock. it's a combination of the value and the dividend, and you have to make sure that you're doing okay. The other thing is, I've noticed based on living through a few market corrections, I mean, big ones, crashes even, that dividend stocks get hit just as hard as the non-dividend stocks. And you might say, yeah, but my dividend just went up to 14%. Well, that's because your stock that paid 7 before just got cut in half. Now you have to wait 10 years for the stock to get back to its original price, but you're still getting the same 30 cents a share as you were before. It just happens to be on a lower price stock. So it would hurt you if you had to sell it. It would also hurt you if you had to, heaven forbid, go to a nursing home or something and use it to live on for emergency purposes, whatever. So again, be careful about dividend stocks. The way we move to insurance companies that provide these pensions are through indexed products, indexed annuities, and life insurance products that use indexing. Most of those products last year made somewhere between like 5 and 15% for last year with no risk when the markets go down. And they're either tax deferred or tax free. And because they have principal protection, insurance companies that offer them are willing to pay you out a higher percentage of that portfolio because they know they're not putting your portfolio at risk. The stock market, shoot, they're not going to suggest you take 6 or 8% out of a stock market portfolio that could go down 50% next year. They're going to say, oh, keep it under 4% because that's the rule of thumb that we've heard, works the long term. Well, with insuring your product and using some of these personal pensions, you can basically use commercial insurance companies to insure your income the same as big pension companies do. So don't discount that, even though Wall Street doesn't like them because you sit your money in there and you get income. They don't get to trade it anymore. They don't make fees on it anymore, and nor do I. But it creates a very happy client, and we like happy clients. So we don't mind that half your money or sometimes even more goes into something that creates guaranteed income that we don't get paid on every year because it makes you much more happy to keep some money in the market at risk that we do get paid fees on that will still have the chance to go up and go down, but it's not that same dollars that you need to live on a month-to-month basis because you've secured your income. So again, the model is different. And I went there about, who gets paid what or how we get paid, because sometimes people wonder, well, why isn't my Merrill Lynch guy telling me this? Well, the Merrill Lynch model is making money over and over again on the same money for the rest of your life, taking money off the table and parking it in something that generates income for you that they don't get paid on an ongoing basis, is counterintuitive or counterproductive to their business model. They know that in the industry, people leave the firm every few years anyway, so they just want to milk the account for what they can as long as they can and hope you make money. In our business, we have very low turnover, and we'd rather keep you happy and keep your stomach from hurting so you're happy to be with the long term. Just a different way we play the game. But I think we play the game and make people a little bit more confident in their retirement. I understand that. I just got told that, compliance and SEC doesn't like us using the word peace of mind. Well, it is peace of mind. Confidence in your retirement is peaceful. It's where you don't get gut aches. And, with insured products, you can have peace of mind. The reason SEC doesn't like us using it is because there is no peace of mind with securities. That's why. And that's interesting that, they've actually outlawed that word in the securities business. Well, it's not outlawed in my business because we do give peace of mind. We do give confidence. We give the opportunity to guarantee income for life. And even when they say based on the insurability or strength of the insurance company, well, guess what? No fixed insurance company's gone out of business in my lifetime, hasn't since the country's been a country. And if they have gone what they call out of business, nobody's lost a dime in a fixed annuity product because there's a surplus and a reserve that pays for all those deficits if there ever is one. And to my knowledge, I can count on one hand any company that I've heard that ever got in trouble and had to go into what's called a receivership and have a company have to come and bail out, but I still have yet to hear about or see a person that's lost even a dime in a fixed insurance product that guarantees income. So again, let's consider the sources of where you get your information. Obviously, there's a little bit of bias when you're working with a Wall Street only firm, and there's a little bit of bias when you work with an independent like me. I like Wall Street, but for the amount you can afford to risk, and I like insurance and security for the amount you want to secure, period. It's a comprehensive look at planning. Oh, and by the way, we want to add some tax planning and long-term care planning and insurance planning and legacy planning along with that comprehensive plan. And that makes up those 5 pillars of planning that we always talk about. It's not just about stocks, bonds, and cash. It's about many more things that create that peace of mind, and I'll use that word, and that confidence going through your retirement that you're not going to wake up scared every other day, depending on what the news comes out or, who gets elected or who says what about tariffs or abominations of bills and happy, big, beautiful bills or whatever. That stuff doesn't have to matter to you if you've set up your plan right.
Steve, that's a very good question. We appreciate you listening to us in Sahuarita. Of course, we'll send you out Jeff's book, Retirement, The Road Ahead. Listening to the program today, you're listening to Jeff and you say, wow, that's a pretty bright guy. I think I'd like to have him take a look at my portfolio. If you don't have a portfolio, maybe begin the process of building a portfolio. We're offering a retirement roadmap with Jeff, no cost, no obligation whatsoever. To get yours, call 520-780-9059, 520-780-9059. As I said, it's not going to cost you a dime. Absolutely no obligation, no judgment. It's just an opportunity to sit down with Jeff in a casual environment. This is just a casual conversation and just talk about what your needs, your wants, your goals are for retirement and design a plan to get there. Again, it's not going to cost you anything. Why wouldn't you call that number today? 520-780-9059. Go ahead and do it. It'll take you about 2 minutes to do that. All you got to do is leave your name, telephone number. Shelley will pick that up, and she'll be giving you a call on Monday to set up that appointment for you. 520-780-9059. If you want to find out more about us online, go to premret.com, premret.com. Jeff, these days, I think a lot of people go to ChatGPT, which is an artificial intelligence tool, and they ask retirement planning questions. But AI alone doesn't really cut it for financial planning. Artificial intelligence, I think, has its place in retirement planning, but it's only a tool that falls short in several key areas that require the human touch. So during the break, you and I went to ChatGPT and asked the question, how much is safe to take out of my investment account if I retire for 30 years and have $1 million in the stock market? It said if you have $1 million invested in the stock market, you can take 4%, which is the 40% rule. That seems to be pretty general advice, Jeff.
It is general advice, and I hate rules of thumb. They're just using, actually, that's way outdated because a guy named Wade Pfau, who actually has a degree in retirement income as a retirement income specialist, he's got an MBA, maybe even a doctorate in it, happened to go to the same alma mater as my school, but found that out after meeting him and reading his books. But he did a study after the crash of 2000 to 2010, or the flat decade. He says, 1.8 is really all you can guarantee out of a 60-40 stock bond portfolio, which is typically the recommended dose of securities in retirement. And so he came up with the idea that why are people not using these indexed annuities? And he's a proponent of them, which is, is kind of hard to believe somebody coming out of college that isn't just running to Wall Street and doing the securities thing, the traditional stuff. He came out and go like, wait a minute, the income thing doesn't really work for retirement as people live longer. And, we have market corrections and things. Maybe we ought to rethink this William Bengen theory, which was the 4% rule, which was reiterated by the Trinity study in the late 90s, before the crash of 2000 and before the lost decade of 2000, 2010. So that's all changed. And it's funny that ChatGPT doesn't have any updates on that. They should probably go out and search around. But ChatGPT is only based on the information that it's given. And so if there's a bias for Wall Street focused people or people that only know Wall Street to be programming the information and the data collected by ChatGPT, it doesn't, maybe go out and find Wade Pfau stuff maybe because, it wasn't programmed into the program. And as good as AI is, it's limited to what's put in it. Garbage in, garbage out, or good stuff in, good stuff out, but it doesn't always have all the stuff, period. So we have to keep that in mind. Speaking of keeping things in mind, based on this new study, I'll go back to what I just said in the last question in the last segment was, let's look at indexed annuities and let's look at principal protected products to secure income from, because your income will last longer, period. And that's why they were invented, and that's why they exist, and that's why happy retirees have them, and that's why our clients are happy, because they have them and they don't worry about where their next paycheck's coming from.
So, Jeff, AI can be a good tool, but it doesn't know you. It doesn't know your emotions. How much of financial planning is really having a back and forth conversation and dealing with people's emotional side of life?
I think most people who come in today, at least to our office and do business with us, are in it because they kind of like the old school personal touch. It also gives us a chance to understand what makes them. I can tell by body language if somebody's a little bit worried about the performance on their portfolio or the risk they're taking or things that happen when we do reviews if they're in front of me. And I don't think ChatGPT cares or knows about that. They don't read anything. I don't think that might be added into AI where it can actually maybe have you put on camera and study your body language and make decisions based on that. But I don't know that it's there yet. It is there in the personal touch. The other thing is just because a 4% rule, according to ChatGPT AI, doesn't mean it's a rule of thumb. Now, ChatGPT I'll give it credit to say, well, it kind of alluded to the fact that everybody's situation is different. This is a rule of thumb, but consider your risk tolerance and other things before making the final decision. And that's true. But ChatGPT can't decide what your risk tolerance is. They can't decide what your budget is based on your current budget, based on potential future budgets. Those things have to really come out of your anticipation of needs that come up that AI can't see. Maybe an inheritance that you plan to get that AI can't see. Maybe it's you have to put yourself out of commission to go take care of an ailing parent because they can't afford to do it themselves, or even supply the necessary finances for such a thing. Do you like to buy cars and go on trips? GPT doesn't know that. I guess if you put all that stuff in there, it might be able to give you some sort of a half-baked rule of thumb answer, but it isn't going to be customized to you. AI does not customize anything. In fact, I have a client that basically is very into the AI. Basically, they sell AI products that generate documents and things like that for companies, contracts, legal things, so forth. And he says AI is kind of topping out from the standpoint of its usefulness, and the growth curve in AI may be, in at least that area of his industry, they're cutting people back because it's kind of run its gamut of usefulness, because it doesn't include the what ifs. It doesn't include emotions. It doesn't include businesses specific values. It doesn't include so many things that are specific and customized to the individual user, that the AI only gets you from point A to maybe point G or H. It doesn't get you A to Z anymore, or where people thought it did. And, if you can even consider, when's the last time you went on one of those chats, online chats, where you're trying to ask the customer service for an answer, they don't know the answer, or they keep answering you some generic way that doesn't answer your question, because your question obviously is something they've never been asked or isn't programmed to ask. And then it takes you forever, and then you can't find a phone number. It says, I can't even find a phone number, to call these people and actually get an actual human online. So there's always a human touch. I think with money, I just can't understand how it can't be human touch. I think we can use some AI for screening opportunities. We have a thing called Annuity Genius, for example, and it can scour every annuity on the planet and give us some feedback as to who's got the best index, what the best indexes were last year, who's got the best income rider, what they're rated. And it could give you things based on today, but it might not give you a history of how horrible these companies are on renewals, or how horrible their customer service is when you actually need money, or how many times they're going to lose your paperwork. We've been down that road, and some of these companies, we already know those things to avoid. But at the same time, that tool is very useful to help put 2,000 companies or products into a funnel and get the 10 best to check on. And then out of those 10, we might know enough about each company and know, hey, these are the 3 best. Now what looks the best? So there's a lot of benefit to AI, but as far as it replacing an advisor, I don't feel threatened at this point. I don't know that I'll ever feel threatened. My kids, my 2 boys that are going to run this business on into the future, are already working with me now, getting their feet wet and getting better and better at it as they go. I don't ever plan to step aside, really, because I really like what I do, and I don't have to do it anymore. I do it because I love it. And so, I'll always be involved. But they ask, what about AI? Are we going to be pushed out of the business? I don't see it. But of course, because of all the feedback that they're hearing and what they're seeing in the real world, they're a little concerned. But honestly, I'm not, based on what I've seen and based on the type of client we see. Maybe in 20 years, that'll be different. But right now, I think it's still about emotions, it's about feelings, it's about what you feel is right. And to be a fiduciary, we got to make our decisions based on all the things that we know and believe, based on what we think is right for you, based on what you tell us you want and you believe and what you need. And I don't see AI being able to do that.
Jeff, running a little short of time, so I think the consensus here is that what you need is a real-life human being who can sit down and understand who you are, where you want to go in your retirement planning, and design a plan that takes into consideration things that AI cannot take into consideration. So if that's you, 520-780-9059 is our telephone number to get in touch with Jeff. Ask for your retirement roadmap at no cost and no obligation. 520-780-9059. Jeff, we're out of time for this week. I want to thank you for your time, but most importantly, as always, every week, I want to thank our fine listeners right here in the greater Tucson area. For Jeff Logan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.